Assalamu alaikum everybody. Welcome back to my channel Rapid Revision. Today's video is about a chapter. It's called Irrecoverable Debts and Provision for Doubtful Debts. And this question is basically from October-November 2022, paper 2 variant 2. It's question number 4. And they are saying here, PG, a trader, sells electrical components. She has provided the following information for the year ended 31st July 2022. So the information they've given you, sales journal for the year ended 31st July 2022. This is basically the credit sales, because sales journal, the total of the sales journal is the total credit sales of that particular business. Sales returns journal for the year ended 31st July 2022. This is total returns that the customers have made to our business. So these are the total sales returns for the year ended 31st July 2022. Then they have given you trade receivables at 1st August 2021. This is total trade receivables at start, because I know that I am just looking at the date. 1st August 2021 is the start date and the end date is 31st July 2022. Provision for doubtful debts at 1st August 2021 is the provision at start. So this is the balance brought down for provision for doubtful debts T account, which is part of the requirements of the question. They've given you a cash book extract of totals for the year ended 31st July 2022. They've given you the amount that we have received from our trade receivables is this amount, 335,100, and the discount that we have given to our trade receivables is 6,500 in this particular question. If you guys look at this sales, so this basically is cash account is being debited and sales account is being credited for this. So this means this is cash sales. And then on the credit side, they have given you one trade receivables dishonored checks. So the dishonored checks are those checks which are returned by the bank because the customer does not have enough funds in his or her account. So the trade receivables checks that we have received and those which we have recorded on the debit side, from these checks there are some checks which have been dishonored and they have been returned by the bank to us, and therefore we haven't received the money from our customers for these particular checks. We haven't received this amount, that is $4,000, which is irrecoverable. Which is dishonored. Dishonored means that the customer gave us a check. When they gave us a check, we debited our bank account and credited the trade receivables account. However, their check was returned to us. So now we need to reverse the whole thing. We need to make the trade receivable again, and then we need to credit the bank account because this money hasn't been received from our customers. So dishonored checks is also recorded when they have given you trade receivables at start, that is the total trade receivables at start. One of the requirements of the question here is to make the trade receivables T account, which is also our sales ledger control account, because in one of my videos also I told you guys that when you are making a sales ledger control account, it's like you are making a total trade receivables account, which we'll be making in this question as well, because it's the requirement of the question that we need to make the total trade receivables account. In the additional information they've given you, $900 of trade receivables were written off as irrecoverable debts on 31st July 2022. So that is irrecoverable debts information. Then they are saying there were no other irrecoverable debts during the year. In the next point, they are saying the provision for doubtful debts is set to be 4% of trade receivables at 31st July 2022. We don't know the trade receivables at 31st July 2022. Hence, we need to make the trade receivables account in order to calculate the balance carried down, that is the total trade receivables at 31st July 2022. In the requirement, they are saying prepare the following ledger accounts for the year ended 31st July 2022, where appropriate show the balance brought down on 1st August 2022. On top here they've written PG. This is PG's ledger in which you need to make the sales account. Sales is always credited because sales is an income account. So you need to record two types of sales here. One is the credit sales and the other is the cash sales. So if you look at the sales journal total, that is 360,000. So you need to record this on the debit side. I'll write here the last date of the year, which is 31st July 2022. 22 for the year ended 31st July 2022. I'll write here total of sales journal, and the total of sales journal here is 360,000, which is my total credit sales. Then I have also made cash sales. If I look at the cash book, I'll see that money is being received for the sales from the cash sales. So cash account is being debited, sales account is being credited. So I'll write here cash, because cash is the other account which is being debited. In the cash book we've written sales, in the sales account we'll write cash. We'll write here 17,000, and the date will be again 31st July 2022. And on the debit side, I have to transfer this to the income statement, because at the end of the year all the revenues and expenses accounts are closed and they are basically put into the income statement account. So I'll write here income statement. I'll write here 377,000, and this will also be 31st July 2022. My account will balance at 377,000, which is my total on both sides, and this is basically my total sales, that is credit sales and cash sales both. In the next account they are saying make the sales returns account. So sales returns account is always debited. If revenue is a credit, sales returns is opposite of revenue. It's like when we sold goods, but some of the goods came back to us because our customers found them faulty. So what I need to do is that I need to post the sales returns journal total in the sales returns account. I will debit this account. I'll write here total of sales returns journal, and this will be 31st July 2022. I'll write here 13,300. This will be my total sales returns, and then you will have to transfer this to income statement as well. Sales returns also comes in the income statement. It's basically subtracted from revenue. You subtract the sales returns. So I'll write here income statement. I'll write here 31st July 2022. I'll total this account 13,300 on both sides. Also, one thing which is interesting is that whenever you're closing the revenue account, you debit the revenue account, like debit the income account, because it's the sales account. A sales account is normally a credit, but then you debit the sales account in order to close it. And what you do is that against that you credit the income statement. So whenever income statement is being credited, like here we are debiting the sales account, and against that income statement is being credited. Whenever income statement is credited, profit is increased. Whenever income statement is debited, profit is actually decreased. Whenever there's, so because of sales returns, your revenue will go down, because whenever there's sales returns, you subtract it from revenue. So in case of sales returns, what is happening is that income statement is being debited, sales returns account is being credited. So profit is basically being reduced because of sales returns. The next account here is the trade receivables account. Total trade receivables account is a sales ledger control account, guys, because lots of students don't know this, and lots of students try to rectify the format, which is not right. You don't need to learn the format by heart. In fact, you need to learn the format through double entry. Whatever is happening to trade receivables, so if trade receivables is increasing, you record that on the debit side. Whenever trade receivables is decreasing, you record that on the credit side, and you will start with a balance brought down, which is this 28,500. So I'll write here 1st August 2021. I'll write here 1st August 2021. I'll write here balance brought down. I'll write here 28,500. This is my balance brought down. And then I will record, okay, whenever we make credit sales, what happens is that trade receivable account has been debited, sales account has been credited. So if you look here, sales, because of sales you have credited the sales account because of credit sales. Trade receivables against that must be debited, because credit sales actually increases trade receivables. So I'll record that on the debit side. I'll write here 360,000, which is my total credit sales. Whenever I'm selling goods on credit, that will increase my trade receivables, because the double entry for credit sales is trade receivables debit, sales credit. So whenever if it's a specific trade receivables and we know the name of that customer, we debit the customer's account and we credit the sales account. But here we don't know the specific customer, so we are debiting the trade receivables account and crediting the sales account for credit sales. Then sales returns will always reduce my trade receivables. Why? Because whenever trade receivables return me goods, what happens is whenever my customers return me goods, the thing that happens to trade receivables is that the trade receivables, whatever they owe us less now. Let's say my customer, I sold some goods to my customer of $100, and then when my customer returned me goods, let's say of $20, now they owe me $80 only. They don't owe me 100 anymore. So I need to record this on the credit side of this account, trade receivables account. I'll write here sales returns, and I will write here the total of the sales returns journal, which is 13,300. I'll record this here, and this date will be, these are ending date 31st July 2022. This will also be 31st July 2022. And then whenever I receive money from my trade receivables, I need to record this on the credit side of the trade receivables account. If you notice, cash book is being debited when trade receivables pay us. So bank is being debited, discount allowed account is being debited. So trade receivables account should be credited, and I'll record this on the credit side. I'll write here bank, and the amount we have received from trade receivables is 335,100. So I'll write here 335,100. Then I have allowed discount of $6,500, so I'll write here discount allowed. I'll write here 6,500. And then I need to record the trade receivables dishonored checks. So dishonored checks, basically this bank, this amount that we have received from our trade receivables, from this amount there are a few trade receivables whose checks have been returned by the bank because they did not have sufficient funds in their bank account. So they basically the amount has not been transferred to our account because their checks have been dishonored. So what you need to do is that you need to record this on the debit side of the trade receivable account, because these customers are still my customers. I need to make them my customers again. So I'll write here bank dishonored checks, and this amount will be 4,000, which is not actually coming from my trade receivables. So these trade receivables are still my trade receivables, so I need to debit the trade receivables account for dishonored checks. Then we have something that goes also in the trade receivables accounts is the irrecoverable debts of $900, which I will record on the credit side of this account. So I'll write here irrecoverable debts. I'll write here $900. So this irrecoverable debts is also going to reduce my trade receivables. Notice that you guys must know already that whenever your trade receivables, let's say they take your money and run away, so you don't expect them to give you the money, so your trade receivable reduces because of that. The double entry for irrecoverable debts is irrecoverable debts debit, trade receivables credit. So you need to record this on the credit side of the trade receivables account, and that's it for this trade receivables account. We've put all the information that was needed to put in that was basically for this T account. I'll write here 31st July 2022. I'll write here balance carried down, and I will calculate my balance carried down. So the debit side total is heavy, of course, and the credit side total is lighter. My balance carried down will come out to be 36,700. This account will total at 392,500 on both sides. 392,500 on both sides. Balance carried down will become my balance brought down, and this will be 36,700. This will be 1st August 2022. So that's it for the trade receivables account. Then we have irrecoverable debts account. So we credited trade receivables for irrecoverable debts. So against that you need to debit irrecoverable debts account. So I'll write here trade receivables. I'll write here $900. I'll write here 31st July 2022, and I will transfer this to the income statement again, because against this income statement is being debited. Irrecoverable debts is an expense. It always reduces your it always reduces your profit. So irrecoverable debts is an expense. It reduces the profit of the business. So you need to debit the irrecoverable debts account and credit the irrecoverable debts account and debit the income statement against that. And this is how you transfer the irrecoverable debts to the income statement. And you transfer any expense like this, because whenever we are also transferring rent, or we are transferring wages and salaries, or we are transferring insurance, all of these accounts are credited and income statement is debited against that. Then we have the provision for doubtful debts account. So we know the provision for doubtful debts balance brought down is 1140. So I will start with that. I'll write here balance brought down. I'll write here 1140. This will be 1st August 2021. Then I need to calculate my new provision for doubtful debts. I'll write here 36,700 multiplied by the percentage here is 4%. So I'll write here 36,700 multiplied by 4%, which will give me 1468 is my new provision for doubtful debts. The latest provision for doubtful debts that I have calculated is on the latest value of trade receivables, which is 36,400. I'll write here income statement. Whenever provision is increased, you record that on the credit side of the provision for doubtful debts account. So I'll write here income statement, and I will write here 1468 minus 1140 will give us 328, and I will write here 31st July 2022. And then my balance carried down will come out to be 1468. So I'll write here balance carried down. I'll write here 1468. This will be 31st July 2022. And this account will balance at 1468 on both sides. This balance carried down will become my balance brought down. And this will be 1st August 2022. Notice that provision for doubtful debts never comes in the trade receivables account, because provision is just an estimation of those trade receivables who might not pay us in future. It's not a confirmed thing. Irrecoverable debts, on the other hand, is a confirmation. It's confirmed that this trade receivable will not pay us in future. So we need to record irrecoverable debts in the trade receivables account, but we don't need to record provision for doubtful debts in the trade receivables account. And the thing about provision for doubtful debts is that this basically the double entry. What is the double entry here that is taking place is income statement debit, provision for doubtful debts credit. So income statement is being debited, provision for doubtful debts is being credited. Whenever income statement is debited, again profit is being reduced because of that. This increase in provision for doubtful debts is always recorded as an expense in the income statement. Then they are saying prepare a relevant extract from PG's statement of financial position at 31st July 2022. So we have the current assets information. So what we'll do is that we will make we'll make two lines here, and then I will write here current assets. So I have current assets information, that is my trade receivables at end. So I'll write here trade receivables. Trade receivables at end are 36,700. I'll write here less provision for doubtful debts. I'll write here 1468, which I will subtract from 36,700, and my answer will come out to be 35,232. That's for my extract of the statement of financial position. When they say relevant extract, they want you to pick that information, pick the information in the question and prepare a relevant extract. So I knew that I have my trade receivables information and the provision for doubtful debts information. So what I do is that I have to think through that what a statement of financial position looks like, and okay, I know my trade receivables, so that means I know the current assets, that is trade receivables, and I will subtract provision for doubtful debts from that. Then they're saying list 3 ways in which PG could reduce the possibility of irrecoverable debts. I just have to list. So I'll write here PG can offer cash discounts. So I'll write here PG can offer cash discounts for prompt payment. So if the customers pay within the specified period of time, they will be given a discount. That is a good way to actually recover the money earlier. Then PG can also improve credit control by reminding the customers of the amount due, Also issuing the statement of accounts and invoices on time. So whenever an invoice is issued, the customer will be reminded of the amount due. Whenever a statement of account has been issued, the customer will again be reminded of the amount due. Improve credit control policy, and then PG can refuse further supplies until the old balance is paid. So refuse further supplies until the outstanding balance is paid. Then in the last part, they're saying state two factors PG should consider when setting the provision for doubtful debts. So whenever they're thinking of the amount of the percentage of provision, what should they think of? So they should think of the number one should be the age of trade receivables. So for how long does the trade receivable, what is the number of months that the trade receivables, how old is the trade receivable? So let's say my one of my customers has bought goods from me and then did not pay me for 6 months. So that's an old trade receivable. So the age of trade receivables. So the thing is that when the more time the customers are taking to pay us, the more chances are that they might not pay us. So the second thing here is that you can say experience, or what was the irrecoverable debts in the past. So the irrecoverable debts in the past, this information basically it goes into the history of trade receivables, and what was the amount of irrecoverable debts in the past. So that can also help us know know what percentage we'll set for provision for doubtful debts. So that's it for this question.